Something is already happening in the institutional gold market that most retail investors are not seeing. Not in the headlines, not in the official announcement, in the positioning data, in the flow of institutional capital that moves before the public narrative catches up to it. The US-Iran conflict is not over. The deal is not signed. The Strait of Hormuz has not fully reopened. Trump called Iran's latest counterproposal totally unacceptable. Iran vowed it would never bow. The war is technically still active, and smart money is already moving. Not because the war is ending, because the war ending has become predictable enough, probable enough, visible enough in the structure of the negotiations, that certain institutional capital does not wait for the confirmation. It repositions on the expectation. That is what institutional money has always done. In every geopolitical cycle I have studied, in every crisis premium buildup and crisis premium unwind of the past 50 years, retail waits for certainty. Institutions move on probability, and the probability of some form of US-Iran resolution, not a clean comprehensive deal, not the complete denuclearization that Washington originally demanded, but a cessation of active hostilities and a gradual reopening of the strait that has choked global energy markets since early March, has risen enough that certain positioning changes are already visible for those who know where to look. This is Capital Briefing. If you are here for the first time, subscribe now before we continue. Activate notifications. What we build on this channel is not war coverage. It is the translation of what institutional capital is doing before the public is told what happened. The gap between those two moments is exactly where wealth transfers occur. Subscribe now. Then let me show you the pattern. Let me start with what most people think is happening right now and why it is incomplete. The conventional retail narrative on gold right now goes something like this. The war is still happening. The strait is still contested. Trump rejected Iran's latest offer. Iran is holding firm on nuclear enrichment. The structural case for gold, fiscal deficits, central bank buying, dollar debasement, silver supply deficits has not changed. Therefore, hold your gold position and wait for phase 3. That narrative is not wrong, but it is incomplete in a specific way that is about to become very expensive for the people holding it without the additional context. The narrative is incomplete because it conflates two different types of gold demand that are currently operating simultaneously, and that will separate dramatically when the crisis resolution arrives. The first type is structural demand. The long-term case for gold, driven by fiscal expansion, central bank accumulation at record levels, the debt arithmetic that makes monetary debasement the path of least fiscal resistance, the silver supply deficit now entering its 5th consecutive year. This demand is real, it is documented, it is not going away, and it will reassert itself powerfully in the structural phase of the recovery. The second type is crisis premium demand. The short-term geopolitical positioning driven by the specific uncertainty of the active conflict, the flight to safety flows, the petrodollar demand surge from oil priced above $100 per barrel, the institutional hedging against escalation risk, the speculative leverage that accumulated on top of the structural positions during the acute phase of the war. When the crisis resolves, when the probability of continued escalation drops enough for institutional risk desks to reclassify the position, the crisis premium demand does not just stop, it reverses. Speculative positions unwind. Hedges come off, flight to safety flows reverse. Institutional capital that positioned into gold as a crisis hedge repositions out of it, and that repositioning creates selling pressure that can push gold below the level that structural demand alone would justify. That is the gap that retail investors almost never understand when a geopolitical crisis moves toward resolution. They expect gold to hold its crisis phase price while the crisis resolves. But the crisis phase price contained a premium that was priced on the assumption that the crisis would continue. When it doesn't, when the probability distribution shifts toward resolution, that premium comes out. Smart money is not waiting to watch the premium come out. It is moving on the expectation of the premium coming out. which is what it always does. Subscribe to Capital Briefing if you recognize the pattern I am describing. Activate the notification bell. The next video maps the specific positioning changes that appear in institutional data ahead of major geopolitical resolutions. What the COTI data showed before the 2022 Ukraine ceasefire premium unwound, what futures positioning showed before the 2020 pandemic premium unwound, and what current data is showing right now about where institutional gold positioning stands entering this transition. Subscribe now, then let me tell you what the smart money is actually moving into. The answer is not what most people assume. When the US-Iran war premium comes off gold, the capital does not simply disappear. It goes somewhere, and where it goes is determined by the same mechanical sequence that drove gold down during the acute phase of the crisis, running in reverse. Here is the sequence as it applies right now. When the Strait of Hormuz begins reopening, and the current negotiations framework explicitly includes a 30-day period during which both sides would gradually lift their competing blockades, oil prices will fall from their crisis-elevated levels. Brent crude rose from approximately $75 per barrel to above $112 in 3 weeks when the conflict began. The directional unwinding of that move, even partial, changes the inflation expectation picture materially. When inflation expectations moderate because oil is falling, the Federal Reserve regains the optionality to consider rate reductions. The oil shock had removed rate cuts from the table entirely. With oil lower and inflation expectations moderating, that conversation returns. When rate cut expectations return, bond yields decline. The 10-year Treasury yield, currently at approximately 4.39%, begins pricing in the more accommodative monetary trajectory. When yields decline, the opportunity cost of holding gold falls. And this is the timing mechanism that most people miss, before yields decline fully, there is a transitional period during which treasuries are attractive on both the yield they currently offer and on the expectation that their prices will rise as yields fall. That is when institutional capital moves from gold into treasuries, not because treasuries are better than gold structurally, because treasuries offer an attractive risk-adjusted return profile in the specific window between when rate cuts become expected and when they are actually delivered. That window is where treasury positioning pays twice, current yield plus capital appreciation from the price rise. Gold, in that same window, faces the headwind of the crisis premium unwinding, while the structural tailwinds have not yet fully reasserted. Smart money understands that timing. Retail almost never does. The dollar is the other destination. When emergency oil demand subsides, the petrodollar bid that drove the dollar index above 100 during the crisis peak weakens. But the dollar does not simply fall. It goes through a specific transition. In the immediate post-resolution period, as institutional capital rotates from crisis hedges into treasuries, and as rate cut expectations return, the dollar initially weakens against the crisis-elevated level. But the rate cut expectation timeline matters here. If the market prices aggressive Fed cuts, the dollar weakens substantially. If the market prices gradual, measured cuts in response to moderating inflation, the dollar weakens only modestly. The current debt arithmetic, $39 trillion in outstanding obligations, approximately $1 trillion in annual interest payments, constrains how quickly the Fed can realistically move, even if inflation expectations moderate. Which means the dollar weakening from the crisis peak may be slower and shallower than previous cycles, limiting one of the traditional tailwinds for the gold structural recovery. That is not bearish for gold structurally. It is a timing consideration for the smart money that is managing position sizing across the transition. Now let me give you what I think is the most important context for understanding why this cycle is different from every previous one, and why the crisis premium unwind when it comes may be larger than anything we have seen before. At the peak of the Iran crisis, gold reached approximately $4,800 per ounce. Silver reached approximately $120 per ounce at its January high before the war began, then fell more than 40% as the crisis premium mechanics took hold. At those levels, speculative positioning in both metals was historically elevated. The commitments of traders' data showed managed money long positions in gold futures near multi-year highs. The ratio of paper gold to physical gold in the market was extreme. The amount of leverage institutional capital stacked on top of the legitimate structural positions was significant. When the crisis premium unwinds, it does not unwind in proportion to the structural demand that remains. It unwinds based on the leverage and positioning dynamics of the paper market, which means the unwind can overshoot, pushing prices below the structural floor temporarily before the structural buyers absorb the selling. That overshoot is where the most dangerous trade in this cycle is made. The dangerous trade is not holding gold through the structural phase. The dangerous trade is confusing the overshoot with a structural change, selling at the bottom of the overshoot because the price action looks like confirmation that the gold thesis is broken, when it is actually confirmation that the crisis premium is clearing. The investors who got destroyed in every historical parallel, post-Iranian Revolution 1980, post-Gulf War, post-9/11 initial spike, were not the ones who held through the structural phase. They were the ones who sold during the crisis premium unwind because the price action looked wrong to them, and then watched gold make new all-time highs 6 to 18 months later. The pattern is consistent. The mechanism is documented. The only variable is whether you understand it before the price action happens or after. Let me now describe the four-phase sequence precisely, because knowing which phase the market is currently in determines everything about the correct positioning. Phase 1 was the panic phase, the first 1 to 4 weeks of the conflict. Oil spiked. Gold spiked initially to approximately $5,400, then dropped hard as the 6-step mechanical suppression I described took hold. Retail panic sold at the bottom. Retail panic bought at the top. Institutions watched and positioned carefully. Phase 2 is the absorption phase, and this is where we are right now. The initial panic has subsided. Gold has settled into what analysts are describing as a ceasefire without a peace deal stalemate range between approximately $4,400 and $4,800. The VIX has moderated. The speculative over-leveraging that existed before the war, leveraged trades that magnified both the initial spike and the subsequent crash, has largely cleared. The market is cleaner. But here is what is happening beneath the surface of Phase 2 that most retail investors are not watching. The structural buyers, central banks, who are purchasing regardless of short-term price, long-term institutional allocators rebalancing into real assets, physical gold buyers in Asia, have been accumulating quietly at the current suppressed prices. They are not announcing it. They do not announce it. They simply accumulate while the retail narrative is focused on whether Trump and Tehran can agree on uranium enrichment timelines. Phase 3 is the structural bid phase, typically months 4 through 18 after the initial shock. The panic-driven selling exhausts itself. The structural buyers, who have been quietly accumulating, have absorbed enough of the forced selling that the price finds a floor. Gold begins moving higher, not on crisis fear, but on the structural fundamentals that were always there underneath the crisis premium. JP Morgan's $6,300 year-end target, Deutsche Bank's $6,000, Wells Fargo's $6,100 to $6,300, UBS's $6,200 by September. Those targets are not based on the war continuing. They are based on the structural conditions that exist regardless of the war, and that get expressed in price once the crisis premium clears. Phase 4 is new all-time highs. The historical record from every comparable cycle is consistent, not a prediction. A documented pattern across 50 years of data. Now here is the specific dynamic of silver in this cycle that changes the risk-reward calculus in a way most investors are not fully pricing. Silver is currently at approximately $80 per ounce. At its January peak, it was above $120. That is a decline of more than 40%. The decline is larger than gold's because silver carries two simultaneous sources of pressure during the crisis phase. The monetary metal suppression from the same yield and dollar mechanics that affected gold, and additional industrial metal selling from growth fears caused by the Hormuz disruption's inflationary impact on the global economy. When the crisis premium unwinds in the near term, silver will likely face a sharper immediate sell-off than gold. The leveraged paper market positions in silver are being managed by desks that are watching the same indicators, and when the probability of resolution crosses their threshold, they will reduce silver faster than gold because silver's volatility profile creates more margin call risk. But the structural bid for silver when phase 3 arrives is more powerful than for gold in this cycle. 5 consecutive years of supply deficit, industrial demand in solar, electric vehicles, AI infrastructure, and defense electronics that is not price sensitive. Chinese restrictions on silver exports as a strategic material, and the historical pattern from every comparable cycle in which silver lagged gold initially and then outperformed it dramatically in the structural phase. The 1979 cycle, gold rose approximately 276% from the Iranian Revolution to the 1980 peak. Silver rose from roughly $5 to $50, a tenfold increase, not following gold, overtaking it by a factor of 3. The structural conditions that produced that dynamic are more extreme in 2026 than they were in 1979. Let me close with the 2 indicators that will tell you when the smart money repositioning into gold from the structural side, as distinct from the crisis premium traders exiting, has reached the inflection point. The first is the dollar index, currently elevated above 99. When this falls back below approximately 97, the primary mechanical headwind on gold prices begins to diminish. Watch for this when oil prices fall on peace deal news and the petrodollar demand surge from the crisis begins unwinding. The second is the 10-year Treasury yield, currently at 4.39%. When this falls toward 3.5%, the opportunity cost argument against holding gold has weakened enough that institutional rotation back into gold becomes mechanically favorable. This will happen when the Fed begins cutting, which will happen when the $39 trillion debt load at 4 to 5% creates fiscal pressure more severe than the inflation the high rates were designed to prevent. The smart money is not watching CNN or Fox or Al Jazeera for the Iran deal update. It is watching the DXY and the 10-year. When those 2 numbers move, the positioning moves, not in response to the headline, ahead of it. The next wealth transfer in gold and silver is not cancelled by a U.S.-Iran peace deal. It is enabled by one because the peace deal clears the crisis premium overhang, lets the structural buyers accumulate at suppressed prices, and sets up the phase 3 structural bid that every institutional forecaster on earth has already calculated is coming. The public will figure this out when gold is at $6,000. The question is whether you understand it now or then. Subscribe to Capital Briefing now if this video changed what you are watching in the gold market. Activate notifications. Every video we publish closes another layer of the gap between what the institutional capital is doing and what the retail narrative is processing. Leave a comment with one word. Are you currently holding gold and silver? Or did you sell during the phase 2 absorption? That one answer tells me everything about which side of this wealth transfer you are positioned on. The smart money has already moved. The question is whether you are watching it happen from the outside, or whether you understand the pattern well enough to be on the right side of it.